How do you actually make money in the Forex market, and what do lots and pips have to do with this? Let's find out in this video. Hey, my name is Winnie and I make videos about Forex trading, especially for beginners. So if you're new to the channel, kindly consider subscribing and hit that bell icon to be notified every time I drop a new video. Before I get started, I just want to say thank you to you guys for subscribing. Thank you for liking the videos. Thank you for your comments. Thank you for your emails. Thank you for your DMs. I don't take that for granted and I really appreciate it. And I hope that I'll provide as much value as I can. So let's get started on the video. Welcome to episode 2 of the whiteboard sessions. So in the previous video, we learned about pips, and just a quick refresher, a pip is the smallest difference that price can make in a currency pair. The point I want you guys to hold on is there is monetary value of that movement. So meaning that every pip in a currency pair has a certain monetary value. It's important to note that different currency pairs will have different values in the pip movement, otherwise also known as the pip value. What I mean to say is the value of one pip in a pair like euro dollar will not necessarily be an equivalent value in a pair like pound yen. So the difference is based on things such as the exchange rate between these two pairs. Before we get into the calculations of how you can determine the pip value, yes, there's a bit of math involved, but not too much though. I want to introduce 2 new words. So we have something that's called a base currency, and you have something else called the quote currency, also known as the counter currency. In a previous video, I explained that in the Forex market, you're going to be buying one currency and you're selling another at the same time, or you're selling one currency and you're buying another at the same time. So in the Forex pairs that we have, for example, euro dollar, what this means is when you place a buy position in your trading account, you're essentially buying the euro dollar, but at the same time, you're selling the US dollar. So a base currency is essentially the currency that appears first in a currency pair, and the counter currency or the quote currency is the one that appears as the second one. So in our example, euro dollar, the euro in this case will be the base currency, and the US dollar in this case will be the quote currency. The formula that is used to calculate pip value is as follows. So you have pip value here times the value change of the counter currency multiplied by the exchange rate ratio. So let's break down this formula. We're going to start with the value change of the counter currency. What does that actually mean? So let's first remember that a pip is represented in the 4th decimal place, and in yen-related pairs, it's represented in the 2nd decimal place. So let's take an example with euro dollar. Let's say the current price that this pair is trading is at 1.2000. So a pip will be represented in the 4th decimal place, moving towards the left. So let's assume that this pair moved from 1.2000 to 1.2001. Now we can see that there's a 1 pip difference. So this is the movement in the number of pips that this pair has moved. Now we have already established that the euro dollar in this case is the counter or the quote currency. Okay, the counter or the quote currency. So with this pair, with this price of 1.2000, it essentially means that for the value of €1 equals 1.20000 USD. Okay, so this will be the value of the counter currency is 1.2000. So when it moves 1 pip, that means we already have the first part of that equation, which is the value of the change in the counter currency. I hope I explained that well. If not, please let me know in the comments below and I'll try to expand on that a little bit. Now let's move on to the second part of that equation, which is the exchange rate ratio. Let me write it down. Exchange rate ratio. So I'll still use the example that I've used, euro dollar trading at 1.2000. So we have already established that the value of €1 equals to 1.2000 US dollars. So we can assume that if I was to write this in the form of a ratio, it would be 1:1.2000, right? So let me give another example. If you're told that for every 1,000 people, there's going to be 1 millionaire, that is for every 1,000 people, there's 1 millionaire. So if I was to write this in the form of a ratio, it would be 1:1,000, right? I hope this makes a bit more sense in relation to the currency pairs that we are going to be using. So we now have the ratio of Euro USD, which was 1:1.2000. But what if we represented this in the form of a fraction? It would be simply 1/1.2000. Now, I've used this fraction because of our formula, which we are going to combine everything that we have learned about the value of the changes in the counter currency, and now we have the exchange rate ratio. So how does all this now come together? Let's find out. So we had already established that price moved from 1.2000 to 1.2001, making that 1 pip change in price. So if I was to write this 1 pip alone by itself, it would really be 0.0001 USD, because this was the change in the counter currency, which is now USD. Now, we have already established the exchange rate ratio, and which was 1:1.2000. And if we write this in the form of a fraction, it would be €1 over 1.2000 USD. Now, as per our formula, I hope we remember it's going to be the value of the change in the counter currency multiplied by the exchange rate ratio. So we had already found the value of the change in the counter currency. It was 0.0001 USD. Now we multiply it by the ratio, which is €1 over 1.2000 USD. Now we notice the USD, these are the same values. I hope we remember our math, so that cancels out. Now I had already done the math before, and the value of 0.001 divided by 1.2000, it was coming to 0.00083 euros. This means that for every 1 unit that you trade on the euro dollar, this is how much that you can make or lose, 0.00083. This doesn't sound like a lot, right? Now let's introduce you. So let's go to the second part of this video, which is lots. So in Forex, you're required to buy or sell a specified number of currency units. You cannot just buy one currency unit. I think the best way that I'll explain this is, let's take an example of a tray of eggs, right? So we have one tray of eggs has 30 eggs, right? So in Forex, you can't buy the single egg as you can when you go to the shop. You can buy just one egg. In Forex, you'll be required to buy in the form of trays. I hope I'm making sense. So a lot is simply the number of currency units that you can buy or sell. And there are 4 types of lots. So we have a standard lot. That's the biggest of them all. We have a standard, we have a mini lot, we have a micro lot, and the last one we have a nano lot. So a nano lot has 100 units. You can buy or sell 100 units. This is the smallest of them all. So you cannot buy anything or you cannot sell anything below 100 units. So a micro lot has 1,000 units. A mini lot has 10,000 units. And the standard, the biggest of them all, has 100,000 currency units. Now, the common factor in this number of lots is that we are multiplying by a factor of 10. If you multiply by 10, you get a micro lot. If you multiply the micro by 10, you get a mini, which is 10,000. And if you multiply the mini by 10, you get a standard, which is 100,000. Now let's use the example that we had done before. Again, euro dollar. Now I realized that I made a mistake. I'm sorry about that. The value of 1 pip in euro dollar that was trading at 1.2000 is actually 0.123483. So this is the correct value of 1 pip that was trading in euro dollar at a price of 1.2000. Now, this is where I'm going to show you how you can actually make money in the Forex market. Let's assume we had taken a standard lot. Now, we have already established that one standard has 100,000 units. So if you took one standard lot, it would mean you'd multiply this by the value of this. So that would be around 8.3 euros. What this means is that if you had placed a trade and it went to your favor by 1 pip, now 1 pip you'd make 8.3. Now let's assume the trade went to your favor by another 10 pips. So when you multiply that by 10, you're going to be making you have already made 83 euros. So as much as you can see the potential to make money in Forex, it's important to also notice that it's also very easy for you to lose money in Forex. Now we had already established what if you took one standard lot at this price, at this value of the pip, which is 0.000083. We had already established that you can make $8.3 euros if trade went in your projected direction by only 1 pip. But what happens if the trade goes against your projected direction and it goes the other way around? So instead of making SASA the 8.3 euros, you'd be losing 8.3 euros. Now, it's very easy for you to make money. It's very easy for you to lose money in Forex. And that's why risk management is one of the most important things that you can have in your trading plan. So don't worry guys, I got you. We're going to talk about this in a future video. So there's another concept in Forex known as leverage. So this could have been part of this video because it also shows you how you can make money in the Forex market. But I think it's a very important topic that deserves a video on its own. So I'll make this in a future video. So this goes out to one of the subscribers, Living Life Responsibly. Sorry I wasn't able to cover that today, but I'll cover this individually in its own video. If you've made it this far into the video, I appreciate it very much. I hope you found value from this video, and if you haven't subscribed, kindly consider doing so, and I'll see you guys in the next one.